In good times and bad, leading stocks serve as a bellwether for the overall market. When the market leaders begin to stumble and run out of steam, it's usually a sign that the market is topping and a correction is coming. In this video, we'll take a look at how market leaders fared as the number of distribution days increased and the Nasdaq topped in late 2007. Just as mounting distribution days served as a warning to investors before the worst of the financial crisis hit, the action of leading stocks also let investors know the bull market was ending and it was time to do some proactive defensive selling. Here's a daily chart for the Nasdaq from 2007. As we discussed in the other video included in this overview of how to spot a market top, we saw 5 distribution days in just a couple of weeks. That much selling in such a short period usually means the market is topping and will begin to decline. Sure enough, the market officially entered a correction on November 8th, as pointed out in the Market Pulse graphic in the big picture. Let's take a look at how some leading stocks behaved during this time. Here's a daily chart for Google. As you can see, it held up pretty well while the distribution days mounted, but when the market entered a correction on November 8th, Google fell down with it. Over the next couple of months, Google tried to rally, but in early January it began a steep decline. Leading stocks may try to buck the overall market trend for a while, but they're usually just delaying the inevitable, since 3 out of 4 stocks will eventually follow the general market. It's important to note that Google had solid earnings and sales growth when it began to stumble. That's why we always say you want to buy on both fundamentals and technicals, but when it comes to selling, just focus on the technicals. Earnings, sales, return on equity, and other fundamental traits are often very good for leading stocks when a market tops, and that can convince some investors to hold on or even make new buys. But when the chart pattern and other technical indicators start to break down, that tells you it's time to sell. Like Google, Dick's Sporting Goods also posted solid sales and earnings growth during this period, but its stock didn't show as much strength. Dick's hit a new high on September 19th, but notice how it closed near the bottom of its range for the day, and volume was weak. That lack of investor enthusiasm for the new price high is a negative sign. By the time distribution days started to mount in mid-October, Dick's was already trading down, and it sliced through its 50-day moving average line on October 17th. If you owned the stock and hadn't sold by that point, it was a clear sell signal, especially since the overall market was also coming under increased distribution. China Mobile was another leader whose price and volume action indicated a change in direction. Despite increasing distribution days on the Nasdaq, China Mobile gapped up in heavy volume on October 17th. A couple of weeks later, it hit new highs, but on low volume. Again, that's often a sign of topping action after a stock or the overall market has had a good run. By that point, everyone knows the story and has jumped on board. There simply aren't enough new buyers to propel the stock or the market higher. Even before the market entered a correction on November 8th, China Mobile had started to sell off hard. As you can see here, even the top market leaders declined significantly when the market topped in 2007. That's why it's so important to stay in sync with the overall market direction. If you regularly count distribution days and watch the behavior of leading stocks, you'll have a huge advantage over other investors, and you'll be ready to act decisively when the market direction changes either up or down.